This is how to trade without looking at the charts. So we've got a chart up here, but we're not going to look at it. This is just an existing position. So what you want to do is open up a watch list that you can trade from. We're just going to use a watch list of high options volume underlyings, and of course we are going to be selling or writing options contracts in this video. And once you've got your watch list open, it doesn't matter what is actually on your watch list, just as long as you have a nice diverse selection of things to trade. And before you do anything, you want to come over and filter out anything that has earnings over the next 45 days or so. And you also want to filter out anything with a low liquidity level. And what you'll be left with is underlyings that have no earnings in the foreseeable future. And every underlying here will have a liquid options market. So that's how you set your filters up. And then on your watch list, you want to have IVR. This is your IV rank, and you want to order your watch list from high to low IV rank. This is simply because the higher the IV rank, the higher our edge when it comes to writing and selling options contracts. Whenever you are selling something first, you're basically short that contract. So you want to sell high and buy low. And when volatility is high, option prices are high. So that's why we want to sell in a high IVR environment. And you want to just go down the list and see what would fit well in your portfolio. Keeping in mind, we're not even looking at the prices right now. We're not looking at the chart. We don't care what it's done. We don't care where it's going to go. Okay, so we're just going to take Walmart here. It's trading at $84.13. It has a very nice and high IV rank of 91.9 and an absolute IV level of 34.3%. So once you've selected your underlying, you want to pull up a list of expiration dates for that specific underlying. These are option expiration dates, and you want to pick an expiration date that's between 30 and 60 days out in time. 45 days is perfect, but you also want to make sure it's a monthly expiration date. As you can see here, the ones with the orange W are weeklies. So we're going to go with April 17th, which has 35 days left on it. And then you are presented with the options chain. Again, we've still not looked at any charts. This is going to give us all the information that we need. We have calls on the left, puts on the right. And you also want to make sure you have your delta column on as well. So your delta, your positive deltas on the call side and your negative deltas on the put side. We have this orange horizontal line that shows us where the price of the underlying is with respect to these strikes that are going down the middle. If you look in the top right, you have your IV level, which is 33.5%. And then in parentheses, you have the expected move, which is currently plus or minus 5.41. And that expected move is also visually displayed with this vertical orange bar. We have these dotted blue lines here as well that show us our 1 and 2 standard deviation levels. And what we want to do is simply, very simply, sell one call and one put. Okay. Now, whenever you are short an options contract, you want price to stay away from that contract. So if we know what the expected move is, in order to get a high probability of success, we simply just need to sell outside of the expected move. And the further out you go, the higher your probability of success will be. However, the less premium you will collect, and therefore the lower your return will be. So it really is a trade-off. And my personal preference is to be around the 1 standard deviation level, or specifically I like to be between 15 and 20 deltas. Okay, so on the call side, we'll start off, we have a 15 delta strike here, the 92.5. We're going to sell that, and then we're going to come over to the put side, and there is a 20 delta strike here at the 77.5 strike. 20 delta contract at the 77.5 strike. And this is basically the trade setup. This is what it looks like. Okay, so we've sold one call, one put. Both of these contracts are outside of the expected move, and they are both in and around the 1 standard deviation level. And as you can see, if we look in the bottom left, our pop here, which is probability of profit, is 70%. So we have a 70% chance of making at least 1 penny on this trade if we hold till expiration. But we don't have to hold till expiration, and I personally never hold till expiration. I always get out early at around 50% of max profit, and that's what this P50 number is showing us here. It's the likelihood of being able to get out at 50% of max profit at some point during the life cycle of this trade. And we currently have an 85 to 88% chance of being able to hit 50% of max profit. So we've got an almost 90% chance of success here on this trade. Now, how much money can we make? So if we were to get filled at this mid price of $1.61, we would collect $161 upfront. That's going to get added to our cash balance automatically by our broker as soon as this order gets filled. And our broker is going to require just over $1,000 in buying power to open this position. So as you can see, we are getting over a 10% return here, which is very nice for a naked, undefined risk position like this. It doesn't use too much buying power, and we have very high probabilities of success. So if we did want to get out 50% of max profit, it would be 50% of this max profit number here. So you'd be looking at getting out around $80 profit. Okay. Now, if you do have a smaller account, or if you just didn't want to allocate $1,000 to this position, you can use some of this premium here to buy some contracts a little bit further out, a little bit further away from the money price, and that's going to limit our loss. So as you can see, we have an unlimited max loss potential right now, so we can limit this loss and reduce our buying power requirement. So we're going to use some of this premium, and we're going to buy a contract just one strike further out on the call side, which is $2.50 away. We're going to do the same thing on the put side, $2.50 away, and buy that. And now what you can see is we now have a defined max loss, and our defined max loss is $186. And the way that's calculated is by taking the spread from the width of our strikes here between our short and long contracts, which is $2.50, and then we're going to minus the premium that we collect up front, which is 64 cents. You multiply that out by the contract multiplier for equities, it's 100, and that's how you arrive at the max loss of $186. Okay, our broker knows what our max loss is, and now we only are required to put up whatever our max loss is in buying power. So our buying power requirement has gone down from $1,000 to $186. So now this is much more suitable for if you have a smaller portfolio. So we're going to collect $64 up front, and we are going to put up $186 in buying power. Okay, so as you can see, we are getting a much higher return on the capital, but the trade-off for this higher return on capital is our probabilities of success, which are now slightly lower. Our POP is 64 and our P50 is around 80 as opposed to 85 to 88. And so that's the trade-off. So we still have very high probabilities of success, but and now we have a higher return on capital, and it's much more suitable for smaller accounts. Now, you do need to keep in mind the amount of buying power that you are allocating to your positions. You don't want to be too aggressive. And so in order to figure out the correct amount that you should be using, if you click the link in the description, you will be able to get access to a free position sizing template. And the way it works is you enter in the size of your portfolio. So let's just say you have a $25,000 account. You enter that, and then below you enter in whatever the current VIX level is. So say if it was 19.2, and then as you can see, everything is automatically calculated for you. Keep in mind that these numbers here are the maximums that you should be allocating. These are not the recommended amount that you should be allocating. These are the maximums. So if your maximum amount of buying power to allocate to a single defined risk position is $1,250, maybe, your average position size should maybe be around $500. But this is just a guideline to show you you should not be going over these limits. Okay, if you were to use the maximum amount of buying power for your position, that says that you have absolute conviction that this trade is going to work out. Okay, so as long as you're sticking to this, you'll be absolutely fine. And if you would like to learn in more detail about what we do and how we do it, again, the link will be in the description. This time, click on EDS Premium. Get yourself signed up. Once you're inside, you will have access to our portfolio, one of our portfolios. And in there, you'll be able to see all the positions that we place, how we manage our risk, how we make adjustments, how we defend our positions, etc. You can use that information to reverse engineer and study, or you can simply copy us. There's also a full course inside as well, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It's a private community, so if you do ever get stuck, you can speak with myself directly or with other like-minded individuals. And there's also a 100% money back guarantee. So once you have been through the full course, followed some of our trades for at least 6 months, if at that point you are not profitable, then we will just work with you for free until you are, or you can simply request a full refund. So it is completely risk-free. It's $9.99 a month to join right now. The price will be increasing. However, once you're in, the price is locked in for you for life, so you are rewarded for getting in early. The aim of EDS Premium is to teach you the skill. We do not want to keep you dependent on us. Once you've learned it, no one can take it from you. And we aim to get you to a point of where you are completely self-sufficient within 6 to 12 months. So with that being said, I will see you guys on the inside.